Good morning, everybody. It is 11 a.m. my time, second Tuesday of the month. Thank you for being here. I really appreciate it. My hope is that I can unmute some of you guys. One thing that is missing from these conversations is what I would describe as kind of a culture, and I'd love to build a culture where I can unmute your microphone and you can ask me a question and there's back and forth. When I do my training and we have our coaching calls, I consider that probably the most powerful part of the training because it's never the first question that's the most important. It's the question that gets asked, a couple questions after the main question. So either just let me know in the Zoom chat and you can just say to me individually, yes, RC, please, when you're ready to take questions, you can. And if not, that's fine. Life will go on, but it would be more fun and more enjoyable, and I think we'd build more of a culture. I did get some people that emailed in some questions, so I will absolutely get to them. And I'll probably get to them first, as I usually do, and then I can open it up to you guys. And before I do that, I want to go over what is in the model portfolio, so you guys have those. So first and foremost is the S&P 500 with dividends reinvested. It is the price chart you see on the screen. And I don't know, do you guys read my PSs? I don't know if you've noticed, but over the last month or two, I don't know when I started, I put a lot more into those PSs, and it's just not for you to get on the phone with me to take training. I put thought and time into what's in there, but no sound yet. Someone says they have no sound yet. Can you guys tell me? I know one person told me they had sound. Could I just hear from a couple other people to make sure more than just one person is hearing the sound? That would be good. And Todd, you weren't the one that told me before that you had sound. Is that correct? It was someone else. Like, Guy, did you? Okay, good. I need to know at least two people from different parts of the country can hear me. Thank you for that. Jim, it seems maybe to be you, though you can't hear me. Yeah, sound is on. Sound is on. Okay. The black line is doing well. It's going up and to the right. And this year we've had over 19 new lifetime highs in the black line. That's the S&P 500. I consider this one of the most powerful price charts on the planet because it's the most followed index. So right now, question one asks, should we be in or out of the market based on the S&P 500 and maybe one or two other things? And the answer is yes. The safe place to be is in the stock market. And we can see that visually by looking at this price chart. Then there's a second question. And I'm working on maybe changing the second question because it really shouldn't be if the first question is this, then what we should do. I think the second question should really be something around what are the strongest parts of the overall investment world? Like, I don't even want to say what's the strongest parts of the stock market because maybe one of the strongest parts of the investment world is gold or is commodities or is the bond, is bonds. And so I think the second question, as I have been using that two-part question for 21 years, I'm getting clearer and clearer over time on what's the best way to ask these questions. And if you've been in my world there's some who have been in my world for over 2 decades, they see that the approach never changes, but over time, the questions and how I approach the process gets clearer and clearer and clearer and clearer. So the second question is, if we looked at the entire investment world, stocks, fixed income, which is bonds and cash, commodities, and real estate, what's the strongest? Where are those strongest segments or slices? And the answer is right now, especially when the black line is going up in the S&P, it's going to be hard to beat other sectors of the stock market. Not impossible, just harder to do so. So here's XLK, and this is going up and to the right. If I divide XLK by SPY, that gives us what's called a relative price chart. And we can see that price chart is still doing strong. XLRE is another one of those prices, another one of those slices that is doing well. It has, over the last month or so, pulled back. And then if we look at XLRE divided by S&P 500, relatively speaking, it's really taken a pullback. So what's interesting to me is to watch if rotation is rotation between the different slices and segments, and if that's all it is, or if there's really kind of a falling out of a segment or a sector. And right now in the model portfolio, XLRE has 5%, where XLK has 10%. The other 10%er is XLU. And again, when we look at it on an absolute basis, it's going up and to the right. And then when we look at it on a relative basis, it looks very similar to what XLRE is looking like on a relative basis. And I think the reason is because it really hasn't been pronounced, but the Fed is increasing their balance sheet again by about $900 billion to $1 trillion a year. And that started increasing on September 11th. And so a lot of things started changing or moving in September. If I just look at this, September 11th is right here. So since money printing has started up again, XLU or utilities stopped going up. Since money printing has started again, we look at XLK, started again on, let's get right here, the 11th. XLK has taken off. Since money printing has started again, I think we looked at XLU before. This is XLRE. XLRE is down again. And then the other 5% of the model portfolio is in GDX. And this is the most pronounced shift since money printing has happened. I'll look at both GDX and I'll look at gold. But GDX spiked before money printing started. And then once money printing started, GDX itself started moving down. But let me just show you gold itself. Here's gold, and money printing started here. And so there's a notice. I think the biggest noticing is really around gold. We've been taught through the Pick of the Month newsletter world that money printing makes gold go higher because it's creating more dollars and it's printing. And it sounds right? When you hear that, it sounds right. Like, well, if the Fed is going to print $1 trillion a year, what happens is they go out into the marketplace. The Fed goes out into the marketplace and buys assets. They buy mortgage-backed securities. They buy bonds. They buy stuff. It's not out of. It's likely in the future they may start buying stocks like Japan does and Switzerland does. So when they go out and buy things, they have to buy them with something. And the something they buy them with is dollars. And they create these dollars out of just pushing some buttons on a computer. So those dollars are getting, air quotes, printed. And part of the reason why the Fed started printing dollars again to buy assets is there are not enough dollars in the world. And so there was some panic happening in August and September. And so the Fed's like, well, the world clearly needs more dollars. So we will start printing more and buying assets. And so we know that when the Fed prints money, people feel safer. And I say that because bond prices go lower, which means the yield goes higher, and stock prices go higher. Those dollars end up somewhere, and they're ending up in the stock market. So the great thing about Fearless Wealth Research not being a gold newsletter or a biotech newsletter or a Bitcoin newsletter is that I don't want you buying gold if gold is falling, right? I don't want you owning the best horse in the gold glue factory if you should just not be in gold at all. And the problem with buying a gold newsletter is you almost make an agreement that you'll keep owning gold even if it slows down the growth and makes your life more uncertain. But what I show you here through research is to kind of be introduced to the idea that words can hijack. But man, if you are trained to understand how to read and follow price charts, it's so freeing. So that's a review of the model portfolio. S&P is in an upward trend. I often talk about how the S&P is outperforming international, and there's no need to be in international. And if you're in international stocks, you have decided to slow down the growth of your money, right? You've decided to, if you were going from New York to San Francisco, what you've decided to do is I'm going to drive at 35 miles an hour because I've been taught that driving at 35 is safer than driving at 65. And the answer is it's not. The equivalent of driving at 35 across the country is having exposure to international stocks. We've been taught that it's safer for us, it's more conservative, but actually it's more dangerous. There's no upside to owning international if they are noticeably and consistently underperforming. And as you can look at this screen, the black line is the S&P. If the black line is going higher, that means US domestic is outperforming international. This is incredibly life-changing, especially if you live overseas. And I've had many people take my training so they actually implement what they know to do, who live in other countries where just this one thing of knowing whether to be in, say, the British stock market or the French stock market or the European stock market or the Australian stock market versus the US has been an absolute life changer to how their money grows. That's it, just one thing. So if the black line is going higher, and it is over time, that means US domestic is outperforming international. And as you can see, it may not do this forever, but we've got a pretty strong trend here. You can kind of see this, that it's going to take a lot for international to take over again. Of course it can, but as long as that black line, maybe this line's a little bit too far in, but as long as that black line is trending higher, you slowing down the growth of your money by having exposure to international is bringing in more instability into your life, not more. By the way, what I just said is considered heretical in almost every realm of financial advising, CFP, Ing, I'm a certified financial planner, and any big box advisor. Because the stuff they teach us, continue, is really about 40 or 50 years old. I talked to a prospective training client. He's like, I don't have a diversification problem. I'm not over diversified. I'm like, oh, what do you mean? He goes, I only have 10 ticker symbols. And I asked him what his ticker symbols were. He's like, well, I got US domestic, I got value, I got some growth, I've got international, I got about 25% in international. And he just kind of listed, they were all equity. What was interesting, and it wasn't my place to coach him or point out to him necessarily. I mean, I did point out to him that you could have one ticker symbol and have huge leaks. But in his brain, he created this mental model that if you only have 10 ticker symbols, there's no way you could be over diversified, even though he was probably slowing down the growth of his money significantly, right? He was driving across the country at 35 miles an hour when he didn't need to. So that's the review of the model portfolio. I'd love to get some questions from you, whether they're questions of concerns or issues or judgments or, hey, what about this? Please go ahead and either say, could you unmute me so we could talk, or if that doesn't work for you, you can type the question in. So first, let me go to the questions that got emailed in. This is from Guy. A while ago, RC, in one of your Zoom meetings, you either said, I make it hard to get a stock into the portfolio, but easy to get out, or I make it easy for the stock for a stock to get into the portfolio and hard to get out. I don't remember which one, and I might be misremembering entirely. Can you comment on it? Well, the first thing I'd say, and I don't remember the exact thing, but I do often say in my training that you want to make it easier to get in the stock market and you want to make it harder to get out of the stock market. And the reason is because over time, the stock market goes up 78% of the time. So, if you take 100 years, 78 you wanted to be in. If you take a decade, 7.8 of those years you wanted to be in. And so all things being equal, you want it easier to get in and harder to get out. As far as the model portfolio, or even more specifically, as far as owning something, and this might be what you're asking about, Guy, is XLU. XLU has gone through periods where it has clearly underperformed the stock market. Here's one in 2017 to 2018. So whatever that is, about 3 months here, underperformed, probably would have underperformed there. And this is a relative price chart of XLU. So in some ways, if you look at this right here, XLU and the stock market are kind of equal, right? They're kind of going back and forth. And so one thing I don't want people to do is to be getting in and getting out. Like, well, I can only be in something if it has absolute strength and relative strength to the S&P. And the problem is it's not always going to have relative strength to the S&P. The question then becomes, what do you need to see to change your mind where if the relative strength stays too much underperforming to the market, you get out? And I can answer it this way. It's not if it underperforms for 2 or 3 months. That is just noise. If it underperforms a decade, that's too long, right? So I'm giving you extreme examples. 3 months, no. 10 years, too long. And so then you start saying to yourself, well, at what point, if it's still going higher, because if it doesn't go higher on an absolute basis, that's an easier answer, right? If you notice, we don't have energy in the portfolio anywhere because this is what energy looks like. So we don't even need to look at the relative price chart. We don't have the material sector. Though it looks better than energy, it's not even at new lifetime highs. And a lot of the lead sectors are. XLK is, XLRE, real estate has backed off, but is just weeks from lifetime highs. Same thing with utilities. So by getting trained to filter out the noise, you get to sleep better because you have this process that you can follow. And so it's a good question, guys. So I think I may have answered your question. You want to make it easier to get in, harder to get out. And I think that actually, as I say it now, it's actually true for whether it's stock or your positions. And really what that comes down to is, do you have a checklist? And I don't mean necessarily you guys specifically, but you guys want an absolute checklist so you can just get up and be like, yep, nope, good, done. Or if somebody hijacks your brain, you want to very quickly go, oh, no, I'm okay. Okay, Tom wrote in, why do you think the stock market will exhale or fall right after the November 2020 presidential election, regardless of outcome? So one thing I've really changed my position on is making predictions. And I actually changed it greatly on this guy who I've been following, Scott Galloway. He makes predictions all the time. And the way he makes them, I like them. He makes a prediction, and then he says, and then we'll adjust. We'll either double down on the prediction or I'll make an adjustment. And so one of my predictions is, and I'm using this word differently now, or I'm using the word prediction. I did the same thing before, but I actually say now, look, I'm predicting the stock market, the S&P 500 goes from 3,000 to 4,000. All right, so if I pull up SPX, which is the stock market itself. I said that when we were around 2,900. I said, look, the S&Ps are going to go from 3,000 to 4,000. That's a 33% increase. And then at 4,000, it's going to get cut in half, back down to 2,000. So let me talk about why I would say this. So number one, the market is going higher. So that's not much of a prediction. Now, it may be more of a prediction that it keeps going higher, but not really. Because I really want you to go back to what Newton said 400 years ago. Someone can correct me if I'm off by a century. Is that something in motion will stay in motion until something of equal and opposite force pushes back against it. And yes, I'm emphasizing because if you have a stock market that is moving up and to the right for a decade, okay, in the longest economic expansion in 244 years, then whatever's going to have it fall has to be equal and opposite in force. And the longer that trend goes higher, the stronger it gets, not the weaker. We've been taught it gets weaker. It actually gets stronger. It's counterintuitive. So my prediction is the S&P goes from 3,000 to 4,000. Okay, now why the 50%? Okay, I don't know if it's going to, and now you, Tom, you said exhale, which is a fine word. And that's fine if it does that, but the market doesn't work if it just goes up. Like it's actually these 40 to 60% falls. And by the way, guys, that's just 40 to 60% in the US. When the US had a 60% drop in the global financial crisis, there were other major countries that fell more than that. And there were other slices of the markets that fell more than that. So some places had a 70% loss. So the reason I believe that the market will go up through the first Tuesday of November is because the guy in office wants to get the job again, and I believe he will do everything he can do to make the market go higher, so people have the experience of, well, I may or may not like him, but the market's going higher. So a higher moving market almost always helps the incumbent president. So he's going to do whatever he can to move higher. That's number one. Number two, Jerome Powell, man, if he's absolutely looking at the stock market, and he's almost basically come out and said, I don't want the market falling more than 20%. Now, Ben Bernanke did the same thing, because if you remember back to 2011, when there was the debt ceiling issue between the Democrats and the Republicans, the market was absolutely falling and accelerating to the downside. And it stopped the day Bernanke came out and said, I will print another $1 trillion. So in this 10-year-ish bull market, meaning a little bit more, basically both Fed chairmen have come out and said, if the market falls more than 19.5%, I'm going to print money or lower interest rates or use words to let everyone know I will be there and save it. I think that runs its course sooner than later. Like, I don't think we're 10 years later and the S&P is at 12,000. I don't. Now, it could, and we should not be attached to where it peaks out, right? So we could go into the election and Jerome Powell says interest rates are negative 2%. He dropped the federal funds rate to negative territory, and he's going to start printing $200 billion a month, right? I mean, he can juice that. What we don't know is how things are going to react or act. But I believe after this next election, there will be and it's very likely that, so that takes the power out of the presidency or Washington. And then there'll be a moment where the market starts falling, where Jerome Powell drops rates, but he can only drop rates so much more, to the point where people go, and I'm actually scared that he's now dropping rates. Like, it's not a good thing anymore. And one thing that people do not understand, what they really don't understand is when people panic, they do not panic into bonds. They don't. When people panic, they do not panic into gold. This is what almost everyone gets wrong because they've been taught this, but it's wrong. People panic into their local currency. So if you were to go study the global financial crisis, right, October 2007 to March 2009, those 18 months, what you'd see, gold fell 35%. Now 35% is a much better loss than 60, but believe me, if you're in gold and you think gold's a safe haven and you see it drop by a third when it was never supposed to do that, that's relatively a lot more scary. During Lehman Brothers collapse, largest US bankruptcy in history, most people don't know this, but the bond market collapsed by 12% in 2 weeks. I guarantee you, people watching their bonds drop by 12 percentage points over 10 trading days is very, very equivalent to panic, right? Because they've all been taught bonds are safe. What the time period where they should have been the safest, they were absolutely cratering. Yes, I'm using hypey-like words. But people are not, people don't get training so they know what to look for and how to look. So it's very likely that when we hit that next correction, when people get scared, they throw everything out. And when they throw everything out, they default to their local currency. The two most popular currencies on the planet for panic is the US dollar and the Japanese yen. Those are the two most popular places where people truly panic. Now, gold can get up back on its feet quicker, but during true panics, everything goes to cash. And most people don't know that. Now, it's one thing to hear it and know it. It's another thing to be trained and know how to get in front of that. So they're very different things. Okay, next question. This is from Jim. Has gold topped out? I'm going to zoom out on gold. Gold is kind of one of the positions. So you've heard me say for a while that if gold, actually, let me bring up gold and not a tracking symbol, GLD. Here we go. I said if gold's above 1380, I'm using the two blue lines as a general area, but if it's above 1380, you should be more bullish than bearish. Okay. The next big turning point for gold is right around like this 1550 to 1580. You can see it over here. Over here, there's a lot. And lo and behold, gold has bounced off that. So when gold hit kind of the 1550 to 1580, it did bounce off that. Now, is gold now going to come all the way back down to 1370? It wouldn't surprise me if it did, right? Because if it stays above whatever the 1380, range, it's fine. But to me, what's most interesting is what happened after the Fed started printing again. Now, if you don't like the word printing and that feels too bullshitty, then what you can say is the Fed started expanding their balance sheet. So that is the cleanest way of saying what they're doing. Are they expanding their balance sheet or are they shrinking it? If they expand it, they need to create US dollars out of thin air to buy other assets. So what it looks like right now, it looks like gold is doing a short-term top, if not a longer term based on money printing, because it bounced off this area right there and it's moving lower. There are three assets that I've been watching. One is gold. If it broke below this September 30th, there's another one, TNX. TNX, not quite September 30th, but if the 10-year yield broke above its close high, which it did right there, that would be a sign of further stock strength and bond weakness. And then you could do the same thing by looking at an actual tracking ETF for bonds. This is the iShares 20-year. Or instead of breaking up, it broke down because this is a price chart where I showed you a second ago the yield chart. So there's some major supports or noticeable points that are getting broken. None of them have collapsed through it. It's very likely that the bond prices will go retest that. The bond yield will go retest that. The gold price will go retest that. but they have broken through that. And the other thing to me that's interesting is we look at Deutsche Mark. This is the 10-year yield for Germany. I said Deutsche Mark, I meant the Bund. Germany's 10-year treasury yield. It broke above its price right here. And just notice the date, September 13th. I don't know what day September 11th is, but at least according to this chart, they were trading days. So to me, the yield came back during the start of money printing and broke above. So the fact that the German 10-year yield is moving higher gives more case to the strength of the stock market and a rotating out of, air quotes, safe-like assets. And then the same thing, if you look at the Japanese 10-year yield, same thing it did here, just soon after money printing started up again. The yield, I mean, look at this, the yield, this is crazy. The yield on the Japanese was down to almost negative 30 basis points, but it broke above that. So a lot of the things we're seeing are a reverse of, oh my gosh, oh my gosh, oh my gosh, the world is ending. And there was this true panic in the bond market. And this is, I believe this is a result of baby boomers retiring and being taught bad information. Okay. And we saw the panic in the bond market, but not the stock market. So I think the bond market is getting dumber over time. And I don't mean that to sound like I'm being a jerk, but you have more people in it getting triggered and scared than you do in the stock market. And that's absolutely what happened in the bond market. US bond, this is the US bonds. This is the US bond market on the top part of the chart, if you want to just look at that. And on the bottom chart is the S&P 500. So actually, I want to zoom out and show you something that I think is really powerful that you're not going to see. Look at the bottom part of the chart for a second. When we went through our last, in '08, we went through the global financial crisis. The bottom price chart fell 60%. The top price chart screamed higher. The top one is bonds. So that's confirming that people are moving into that bond price. A higher price on the top is saying people are getting scared. Okay. In 2011, when we had that 20%, almost 20% fall, and Bernanke came out and said, I'll print more money. Look at the top price chart. That black line went higher. That's people slamming into the 30-year bond market again. Now, the bottom price chart's harder to see, but it just went sideways. It didn't even fall a full 20%. And then you go back to, you move forward, but then we go back to 2015, 2016, where the market went sideways for a year. And the bottom chart, the market goes sideways. It had 2 or 3 13% falls. But look at the top price chart. Again, people screamed into the bond market. Now, that all makes sense. Stock market falls, bond prices go higher, right? Now look what happened. Here in October, you have these little falls and the bond market panics higher. So if you look at the top price chart, it panics higher. And yes, the first part of it, the S&P fell down here, but then the S&P moved up into that panic. It moved up 27%. Guys, 27% higher is not trivial. So to me, what's so amazing is this panic in the bond market. The bond market is panicking while the stock market isn't. And I think it's because we have more and more people retiring. They've been taught bonds equal sign safety, right? When you stop your earnings runway, you actually become a worse investor, unless, of course, you get trained by yours truly. And I don't say that arrogantly. I've had a lot of people go through the training in their 60s who, I had this one woman call me. She goes, my friends looked at my allocation and they said I'm very aggressive. And I was like, what does very aggressive mean? Oh, well, you have my money in stocks even though I'm in my 60s. I'm like, oh, that's called stability or probability. So it's not trivial to go against culture, even though it's best for your money. Okay, long answer to, has gold topped out? Okay, one last question. You referred to stop losses earlier but not lately in the actual implementation of stop loss strategy. So in these questionings, I don't really get into stop losses. I believe there should be a point where you ask yourself, how I know I will be wrong, or at what point do you say you're wrong? And just think about that question for a second. Hey, let's call the person Tony. Hey, Tony, at what point do you know you're wrong? And imagine if Tony answered you, I don't understand the question. I'm 60 years old. I'm in 50 bond, 50 stock. There's no point that I'm wrong. What? So if you're driving in the wrong direction, there's no point ever where you're like, wait a second, these are the wrong signs for Canada. I see signs for Mexico. Like, at what point do you know you're wrong? And no one gets trained this. In fact, what they do is they're taught to not even ask that question. They're taught to ask bad questions. So one of the best questions is, what point, RC, if I own X, Y, and Z, or A, B, C, or 1, 2, 3, how do I know when I'm wrong? And it's something that I train people to know in the training. So it's like, how do I know when I'm wrong? If I'm 100% in stocks, regardless of my age, at what point do I say, oh, got it, the boat has changed directions, or it's no longer good to be in this asset? That's a super critical question. Most people do stop losses absolutely wrong. I've been training people for 2 decades. I've been in the markets for 3 decades with my own money. And I can tell you that most people who even get the concept of stop losses, they do them absolutely wrong. And the way they use stop losses increases their losses. So yes, I believe in stop losses. The Fearless Wealth strategy has stop losses, but it's not based on like a 10% trailing stop loss, something like that. It's dynamic, meaning they shift and adjust with the market. So that's more of a training question, and that's not a research or a model portfolio question. I didn't have any more questions come in, both through the group chat or through emailing in. If there's questions that did not get answered, please email them in and I will answer them next month. I appreciate that. And I really think that's it. So thank you guys for being in my world. I appreciate it. I will get this video uploaded and I'll speak to you guys next month. Okay, thanks.